Most investors spend their time watching the S&P 500, the Nasdaq, or whatever stock is trending that day. But if you're a serious market participant, retiree, or someone building a long-term financial plan, one of the most important numbers to watch is still the price of oil. Why? Because oil does not just affect energy companies, it affects transportation, food costs, airline prices, shipping costs, consumer spending, inflation expectations, and ultimately interest rates. When energy prices rise, inflation can become harder to control, and the Fed understands that. When inflation becomes harder to control, the Federal Reserve may have less flexibility to actually cut rates. And when rates stay higher for longer, that impacts bonds, stock valuations, borrowing costs, and retirement income planning. For retirees, this matters even more. If you're living on fixed income, inflation is not just an economic data point. It's a direct hit to your purchasing power. Your groceries cost more, your utilities cost more, travel costs more, healthcare costs more. And if your portfolio is not structured with inflation and volatility in mind, the real value of your income can erode over time. This is why investors should not build portfolios based only on recent performance. A strong portfolio needs to account for multiple environments: lower inflation, higher inflation, failing rates, rising rates, strong growth, weak growth, and geopolitical shocks. Oil is a reminder that markets are all connected. We live in a geopolitical world or a globalized economy. Energy prices affect inflation, and inflation affects the Fed, and the Fed affects interest rates, and interest rates affect valuations, and valuations affect your portfolio. So the question is not, what did the market do today? The better question to ask is, my portfolio prepared for the risks that could affect tomorrow? At Portfolio Capital, we believe disciplined investing starts with understanding the economic forces behind market movements. This is not about reacting emotionally to headlines, but more so about building a portfolio with intention, structure, and risk management.